Welcome to the beginning of the end. We are on the home stretch, just a couple more things to cover and we will get everything sent off and finished. In this video, we're going to quickly go over what estimated tax payments are, why you have to send them off, and how we actually go about doing that. Now, for some quick background, the US tax system is designed to be a pay-as-you-go system. That means that as the year goes on, you are expected to send in taxes to the IRS every month, every 2 weeks, sometimes even more often than that. Now, in most cases, if you're an employee, you don't even notice this. Your employer just withholds a chunk of taxes from your paycheck, they add in their half like we talked about, and they send that to the IRS, usually every 3 to 4 months. Because you now own the business and you are the employee and the employer, however, it is now your responsibility to send in those taxes every couple months. That is where estimated tax payments come in. At the beginning of each year, you're going to make your best guess as to how much money you're going to make for the rest of the year. That's where the estimated and estimated tax payments come from. You're just making an estimation as to how much money you're going to make. Using that income, you're going to calculate how much tax you're going to owe that year. You're going to break that into 4 parts, and every 3 months or every quarter, you send that off to the IRS to make sure you're always on top of things. Now, there are 2 reasons that you want and need to do these estimated tax payments. Number 1, if you don't make these estimated tax payments, there is a 90% chance that you will be charged a penalty when you are filing in April. That's really just the IRS's way of saying, whoa, you didn't give us enough money during the year. That's not cool. Number 2, it keeps you from having to write a giant check to the IRS at the end of the year, which usually causes tons of problems. Trust me, I've seen this happen dozens of times. You tell yourself you're going to keep a chunk of money to the side to pay taxes at the end of the year. Then, as the year goes on, stuff keeps popping up. You need to make payroll one day, materials get more expensive, or maybe you just need a little bit more money for you personally to cover rent or groceries. Then, the end of the year comes, you're filing your taxes, and all of a sudden, you're looking at this $5,000 bill that you do not have the money for, plus the penalty. Super not cool. Fortunately, there's a super easy way of calculating exactly how much you need to make in these estimated payments, as well as when you actually have to send them in, which is what I'll talk about in the next lesson. I'll see you then.